Happy Friday, traders. It is 8:01 a.m. in Chicago time, 9:01 Eastern on Friday, the 16th of August, 2019. It's Friday. Yay. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, welcome to episode number 1576. Does anybody want to take this over? I'd like to sleep in. Um, This morning, risk on sentiment, the market is popping higher. The Nasdaq's up over 1% from settlement. It's up 78 points. The Russell's also pretty strong this morning, almost up 1%, 0.95%, up 13 or 14 points, trading at 1477.1. The Euro stock strong as well. S&P up from settlement 25 points. 25 points, 0.87%. So you get the point. The money is flowing into risk this morning. Gold is the laggard. Gold's off 10 bucks or 0.67%. And the bonds are off 16 ticks. Now, that's pretty small relative to the recent movement. The yield's been falling pretty good. The 10-year note is down 8 big ticks. So one thing to remember today, it's the third Friday of the month. What happens on the third Friday of the month? Since you're all well informed and expert traders, it is options expiration Friday. Some options expire in about 27 minutes. Others expire at the end of the day. This is not quad witching, but just keep in mind that it is expiration Friday, and so there's potentially some movement as a result of that hedging and so on. So again, the market sentiment is bullish this morning, is risk on. In terms of what's driving this, really, there's nothing special here in terms of problems being resolved or whatever. Generally, the market is just experiencing, in my opinion, is experiencing a relief rally given the way the last week or so, 2 weeks have gone. There's more and more expectation across the globe of central banks intervening and offsetting worries about this growth slowdown. Remember, the markets don't trade on technicals anymore. They're just addicted to, Fed crack, central bank meth or crack. Overall, the market is, driven by leveraged swaps and things like that. So interest rates are very, very important for the health of the overall economy currently. It's been like this for some time now, thanks to Greenspan, I guess. The dollar's higher against a basket of major currencies. Gold fell, as you know. Oil prices are in positive territory. The OPEC report came out this morning. And it's projecting a further slowdown. It is likely that OPEC will take steps to reduce the impact of that. The main release today that we need to be aware of is Michigan sentiment. This is the prelim. This can be a mover. The final figure often is not, but the prelim actually moves this around. Consensus is for 97.2. The prior's 98.4. So that comes out at 10 o'clock. Other than that, the calendar's free and clear. Don't forget that we're heading into the weekend, so look for some squaring up at the end of the day. That coupled with the options expiration. Let's take a look at what we expected yesterday versus what we got in our review segment real quick. Yesterday, the main expectation was that we are likely to drop below the prior low. The action on Wednesday was a gap down, and we consider that an impulse down. So it's, as it says there in a caption from yesterday, the flow is easier to the short side. So I'm going to be looking short, looking for a penetration through the low. Don't know how far it'll push. Was looking for the next stock zone at about 26 or so. And then I was looking for it to pop back in and balance out. I was looking for yesterday to be more of a balancing, basing day for potential rotation up, which we're getting today. And that's what scenario one here is setting up. We clean up this weak low, test below, and then pop back into the range. And I projected it going as high up as the low volume node, which is at 70 and a quarter. Obviously, we didn't have that kind of range. Yesterday was kind of a meh trade. Here's what actually happened. What's interesting here, it's too noisy. Here's what actually happened. We open up, we drop out of the range almost immediately. Right here, we drop out of the prior day's range and then push right back in, drop again, push back in, drop again, push back in. What we end up with is a P-shaped profile, but this is not a traditional P-shaped profile. This is not what we would call a short squeeze profile, because what that looks like is it opens, runs up, and then consolidates, resulting in a P shape. This is not what happened yesterday. We did see a lot of balancing behavior. So if you, like me, was again and again taking that mid, it was good for one or two scales, scratch, one or two scales, loss, one or two scales, loss. It was definitely not directional yesterday, but the volume was, I thought, was pretty good, 1.56 million. The range was relatively decent, 28, 25. Remember, 26 was what I was looking for. That was the next stock zone down. We went to 25, pushed by 4 ticks, and then but the range is 25 to 57. That's 32 points. That's pretty good, even for a balancing day. Overall, we started to base, and what happened is as soon as we opened back up, we had a quick pop higher. There it is. As soon as we opened back up on nothing, uh, it just quickly popped higher, and it was just obvious that that high was not going to stay. Quick pop higher, pull back to the open, and then we've been trending up pretty much the entire session. We've been slowly grinding up, and you can see there's not a very clean formation of these high volume nodes. It's just kind of a jagged, um, looks like a key or something, a profile. There's no consensus in the overnight session. Inventory is almost 100% long, well, relative to the prior close. Um, and we could see that the delta is also positive, has been positive most of the night. It's revisited parity for a couple times, or zero a couple times, but overall it's pretty positive. We're trading at 28.70 currently, and yesterday we closed at 28.47, 28.47 or so. So it's pretty strong this morning. Let's take a look at what the order flow looks like. It's one of the cool things that I would love to do is to be able to show, I guess, to show where the liquidity was when I did the trader bite yesterday versus how that liquidity responded as the action took place. It would take a little bit. I just don't have the time to do it. But as you can see, right off the open, we push higher. We push higher on the reopen, and then from there we just keep squeezing. There's pretty decent liquidity here, and this is the area we're trading currently, 28.70. Pretty decent liquidity at 28.70 that gets tested once for a rotation of about 8 points, and then we have a collision that takes place right there, and more collisions, and that size trades out. So, and that size also keeps popping in and out as it's trading this price. And as you look higher, there's this uh, constant liquidity coming in, there's actually a wall of it that showed up right after 7 o'clock my time. See this wall right here of liquidity, and that stuff has been trading out. As the market pushes into it. It's quite interesting to see how that's going to play out. I don't know how much of that, you'll notice that this liquidity, the strikes in the S&P are 5 points apart, and you'll notice it's at liquidity is at 70, liquidity is at 75, liquidity is at 80 right here, liquidity is at 85 right there, liquidity is at 90 right there, and 95 right there. So this is why knowing that it's options expiration is important, because I'll give you an example, just a scalping example. Let's say I'm scalping long and I'm looking for 86s or something. I need to be aware on a day like today, there's probably going to be a delta hedge or something at 85. I'm probably better off scaling out at 85 or not taking the trade at all. If I say enter at 84, I know that the size overhead is more likely to trade than not because it's a strike on expiration. And so this is something subtle. I hate the word secret in our business because what that means is it's a trade secret or a professional trader secret, which means I'm going to charge you something for it. But this is just common sense. If you understand how delta hedging works, you know that you have to cover whoever's short those strikes has to cover, and the way they do it is by protecting their position using futures. And so this is very common for this day. As we look, the 65 doesn't look like it's got a lot of liquidity, but the 55 does, and so on, and 45 does, and usually the 50 will, but it doesn't currently, and so on and so forth. Very interesting. Nothing probably you can use for your trading, but just be aware that that's how it goes, right? In the S&P, you're going to be paying attention to every 5 point handle, the fifth handle of every of the price ladder, and just be aware that it may have a little bit of difficulty getting through there. If there is liquidity, that it's more likely than not to trade out. Anyway, that's how things look. You've got the liquidity picture. Let's take a look at what we're expecting for today as we come into this session. Of course, it is, I know, you guys love this. It's like Friday, right? Take a moment today to hit the like button on YouTube. I know there's not one on Periscope, but take a moment to hit the like button. I'd appreciate it. It makes the channel easier to find for others when they search for futures or whatever. Um, toot, toot. So let's take this back. So here we are. We're starting to revert back. I'm gonna start off, because these are overlapping values here. I'm gonna start off by putting a micro composite on here to see what this profile looks like. So we have a very prominent point of control at 28.48. That's our magnet for today. If we start to roll over, 28.48 becomes a big area that the market's likely to attract price back to. We're opening in a gap up inside of Wednesday's range. I'm looking for an open auction out of range. I'm looking for a reversion back, uh, uh, to the prior range. If it does not bounce off of or create a gap, okay, so the first scenario is likely to bounce off and then start moving towards the overnight high, and then potentially challenging the high from a couple days ago at 28.90. And remember what I said yesterday for that primary scenario, that we're probably setting up for a 28.93 retest. If you recall, the 28.93 was that low volume node. And remember yesterday I said, is if we test lower and finish up on scenario one, here it is. I'm going to show you it real quick. On scenario one, we're looking for this 28.93 that I marked right here, and that's what's likely to be the target, the big target for today. Okay, so I'm going to be looking for that. If I see that on the way down, it's getting some support, it's getting some. There's some bid liquidity that's refilling. There are some good collisions going on. There's not advancement given the effort by sellers. Then we're likely to see a short squeeze and a quick run up to the overnight high. And then beyond the overnight high, we have 28.8975, call it 28.90 because we're not rocket scientists. But 93 becomes the key target above. Okay, if it fails at 93, then it's likely to pull back to lower prices to entice more buyers to fuel the next leg up. If it's not able to fuel the next leg up, then we're looking towards 2801, 2801.50 or the 2800 century figure, but let's not confuse things right now. The secondary is a move, is an open that just glides up, and if it runs into any resistance, pushes into the low end of the range, pushes down into 28.48, and we are likely to base here into the weekend. This is also a likely scenario here, as the market would not want to, participants would not want to put risk on into the weekend given the current environment. I mean, one tweet can move the market 60 points. That's a tremendous amount of risk for those who seek to get long, although prices are relatively cheap technically, right? The market on many technical, traditional lagging indicators, technical indicators is oversold. So there are those out there who are going to be looking for it to turn up. So those are the two key scenarios. The third scenario is actually bullish, right? Given the break is an open test drive, which shows us an impulse, consolidate, push through 90, push through 93, and then squeeze up. Use the 93 as a pullback area, and then finish actually higher. Not very likely, but we've seen the market squeeze the heck out of those shorts and the bears, and there are many bears over the last 2 weeks just tweeting away, and it can squeeze the heck out of those very, very quickly. Even this one here happened on news, but even without news, the market's very capable of doing this. In either case, don't marry your position. Just date your position. Do the Tinder thing with your trades. Move on quickly if things don't work out. And so the biggest thing for all of us as traders is our enemy is not the market. The market's not out to get our money. That's not true. Do not believe in that crap. It sets you off in the wrong mindset. The right mindset is that your job is to align yourself with the market, and find the wave that you can surf the lowest potential risk for the highest potential reward. That's it. If you fail at doing that, the market will take your money, just like a surfer is going to, plummet into the ocean if they don't read the waves right and doesn't ride them right. It's just the way it is. Just make sure you define your risk, and your job is not to decide, hey, these are my scenarios and the market has to do it. No, our job is to define and find out what the market wants to do and to align ourselves. And these scenarios help us keep the big picture in mind. They're built on hourly charts and going down the line to figure out where the market might present resistance and so on. That's what those gray areas, the stock zones are for. Okay, so take what you can get, make sure you define your risk, and have at it. Good luck today and have a great weekend. Let's not go into the weekend with a big loss, okay? Good luck.